Patrick Leary is joining, Chief Market Strategist at Incapital. Patrick, what should we expect from the Fed this week? We know there's not going to be any change to rates, at least that's the expectation. But what about talk about what's to come?
Hey, good morning, Oliver. Thanks for having me. Yeah, I think you're right. When we're talking about the Fed meeting here this Wednesday, we're likely not going to see any kind of policy changes or changes to their current programs. I think you're gonna hear them talk a lot about their lending programs, whether that's a Main Street lending program or different credit facilities that have been created and how well they've done the efficacy of these programs. Additionally, I think you're gonna hear them talk more about yield curve control and what that looks like going forward. And I think that the reason that some people are looking at interest rates and seeing interest rates going up here, definitely there's a reason to think about why rates would be going higher, whether it's increased debt issuance in all sectors of the debt markets or just specifically related to treasuries. I think one thing you have to remember as we go into the Federal Reserve is that a short time ago they commenced upon a bond buying program in which they were purchasing treasuries in the open market for two reasons, and they were twofold in the fact that they wanted to support the liquidity functioning in the market as well as provide for accommodation until the labor market gets somewhat back to normal. And I think that even though we had a great jobs number on Friday by all accounts, 13 to 16% unemployment is probably not going to be something that's going to take the Fed's foot off the gas of accommodation right now.
So when we talk about accommodation and the effects of it, it seems like the places you want to go to not fight the Fed have narrowed. It's basically just stocks now. Patrick, bonds broke last week. Gold is flatlined. Why are we seeing this specific reaction now in equities? And does that mean it has more strength? What are the implications now that everything rally from 2019 has basically been whittled down to just stocks?
Yeah, well, this goes back to the goal of the Fed, really, and whether or not it was, the specific outright goal or the net effect that happened anyway is something called asset inflation, right? The Fed was unable to produce, inflation as it comes to consumer goods and inflation in the general inflation in the economy as we would normally measure. But they've certainly taken out any of the return that would come from other asset classes by keeping interest rates very low, taking out, like you said, volatility in many other marketplaces. And that's really done its intended job of pushing investors back into the stock market and reinflating the stock market. Now, what can happen here, and people say, well, the stock market is disconnected from the real economy. A lot of times, though, what we see is that the wealth effect of a rising stock market can help lead the economy out of a real economic recession, because if people feel more wealthy, if their 401k balances are higher and their retirement accounts and investment accounts are rising, they're more likely to go out and spend money at a restaurant or go out and buy something, or when travel becomes something that people start doing again, to get back to it at least much quicker than they would otherwise. So I think this is what you're seeing, is that the Fed did a really good job of reinflating the risk markets, and then that can start to translate back into the real economy and keep things going. And I think that's what you've seen the Fed do here.
Reflating, is there potential that turns to inflating? Is there a response by investors then in choosing asset classes, bonds versus stocks, that's very easy right now? What's the easier trade, long stocks or short bonds?
Yeah, I think something you have to think about here is the unintended consequences of the massive amounts of debt issuance that have happened both at the government level as well as the corporate level. We're still in the very first innings of that whole thing. I mean, trillions is the new billions these days, and the amount of money that's being pushed into, companies' balance sheets in terms of their leverage. It's gonna really depend on the companies and how they're able to get their revenues back, if they're able to control costs in other ways, and that can leak its way into the stock market. An outsized debt burden can definitely leak its way into the stock market.
Is there going to be a wake-up call at some point if there is not another leg of fiscal support coming, or is there any other clear catalyst for a downside move in markets right now? It seems that we've just cruised through everything. We've cruised through riots. We've cruised through some troubling data points on the virus accelerating in some areas of the country over the last week. But even though all that's happened, the markets just kept climbing. I mean, is it obvious what's going to get in the way of it?
Well, I think, we're going to continue to see the Fed be accommodative both in their interest rate policy and their lending programs. Many of these programs, we haven't even seen the full effect of how much ammunition that the Federal Reserve potentially has. Just talking specifically about one program, that's the corporate bond lending facilities. They haven't even purchased one single bond, individual bond, and already they've been a net effect to tighten credit spreads significantly and open up the corporate credit markets for companies to be able to borrow. So I think that, in terms of are there some things to be worried about in the future, there's always something to worry about, whether it's the amount of debt that's being, that's being issued in order to get us there, or whether or not it's a reemergence. I mean, obviously, economies are starting to open up. New York today is going into phase one openings. Like you mentioned, we had riots and protesting throughout the country, and that's probably the furthest thing away from social distancing. So probably in the next 2 weeks to 30 days, we'll get a sense whether or not the virus and is reemerging. If it is it reemerging and causing more hospitalizations? Can the hospitals handle it? This would be something that could weigh on risk assets going forward if the idea is that, well, maybe we can't open the economy up as quickly or as openly as what we had once wanted.
Patrick, one other point here about the possibility of yield curve control the Fed has hinted at that we've seen way back in the past around World War II. Japan's currently doing it. The idea that the Fed would anchor yields somewhere along the curve. Most folks that discuss this think about it on the short end. Is it obvious what the implications of that would be for the bond market? Does it steepen the yield curve? Does it put a halt to the recent selling in long bonds? I have no idea how to consider what it would mean for the 10-year.
Well, I think that, what you have to initially some of the talk that was coming out of Federal Reserve governors and policymakers was yield curve control for the front end of the curve. And that's why you are seeing more of a steepening happening. People are less likely to be bearish on the front end for two reasons. Number one, they know that the federal funds rate is unlikely to move for a period of time. And then at the same time, they know that the talk of yield curve control is something that's been a topic of discussion and something that they'll be looking into. And they've been specific about the front end, but that doesn't necessarily mean they have to stay focused on the front end just because that's what they've talked about so far. They can implement controls all across the curve, especially if they felt like long end yields were getting out of hand to a point to where the Treasury was starting to have a hard time issuing debt longer out the curve, because that's something that the Treasury is been very adamant as well about wanting to do. In fact, this week we have new 3 years, 10 years, and 30 years coming to the market. So this will be an interesting week in terms of watching the price action in the bond market.
That first test we're going to get later on today with that 3-year note auction, then the 10-year tomorrow. Patrick, Leary, appreciate you joining us here on Morning Trade Live from Incapital. Good conversation about the macro setup into this week.